right, jot down the time here. Okay, there we go. All right, Fernando. How are you doing, Fernando? It's good to see you here. He says, hi, Mike. What do you think about nesting an out-of-the-money debit put spread and a married put in order to have better protection in case of a decline? At a small cost to the structure, but it has a very low risk-reward ratio. In case of a decline, it can be useful. Okay, let's take a look here. My initial thought, without looking at the graph, Fernando, is that paying the debit, an out-of-the-money debit spread? Out-of-the-money debit put spread. Usually you'd want to be in the money, but you're going out of the money. I see it now. Okay. Okay. So I'm trying to be rude. I'm looking for mine. I don't mean rude in that sense. That you got to be kidding me. It's gone already. Oh, there it is. That's not the one I'm in. We'll do the one that I'm in, and I don't think that was the right price. It's anyway, this is the new married put that we opened for Fusions. I opened for Fusion subscribers, I think, on Wednesday, and then Ernie opened one yesterday on DT, which was on the first page. So let's just take the profit and loss chart to the married put position. This one's an 8.6% risk. I'm shorter term. I think I went right to May. Yeah, it must have been May. And of course, we're in the 25 put. And my prices were a little bit different, but the risk came out to be about 5.1%, if I'm not mistaken. Wow. Okay, so we're at the same risk roughly in that case. All right, so where are we here? In a long-term married put position, I'm neutral to bullish on the trade in that case. And expecting the stock to move up, and I'm going to use the 12 different income methods. And the question Fernando is asking is not one of the 12 income methods. Why? Well, normally what we try to do with the income methods is be able to reduce risk first. Whether that's through income, getting a higher guaranteed exit. Some income methods will increase the risk. Well, that's if the stock fell, we're looking to reposition and take the profit off of the put and get a lower strike put in that case to continue the trade if we're still bullish. Out of the money, bear put debit. You said a put spread, so it would be a bear put debit. So what does he mean by that? Well, in a bear put debit spread, let's just say ESI here, 2260. What I might do is sell a 24 strike put that's slightly in the money, and at the same time buy a higher strike 26 or 27 put. It's deeper in the money. Remember, the puts are in the money when we're up here. And that would be a typical bear put debit spread. We profit if the stock falls below the short put strike price or stays there. And of course, we lose if the stock moves up, which is the initial bullish implication that I had in this case. Now, before I go further, Fernando, I do want to check something. What is the main reason why I opened a married put or this married put on ESI? I'm bullish on the stock, yes. But in general, when I select one from the list, this might go into Stefania's question. I haven't read her question all the way through yet. But my expectation in this scenario is that I feel the stock has the potential to move up 3 to 6% or so in the next 30 days, 20 days, something along those lines. Let's just take the higher range of that expectation. Let's say it moves up 5% in the next 20 to 30 days. It'd be about $1.13, right? $1.12, $1.13 in this case. So we'd move up to 23.70. 5% movement. It'd be 23.70. Okay, let's call it 23.75. All right. All right. So what happens? What is my expectation? If the stock moves up to 27.35 on November, 30 days, November 15th. Okay, so expectations not too great, make $23. I think this this is using the Black-Scholes pricing model. It's not going to change it too much, but I'm going to lower it down to the SIV of 0.30. It should have been less of a decay, not more of a decay. In any case, that's all right. So a profit expectation of about $23 if the stock moves up 5% to 23.75 on 11/15. Let me jot this down, Fernando, before I get the numbers. Okay. Okay. Now, let's say we got a 10% movement. Remember, the stock's at 22.60, so let's say it moved up another 220. We moved up to 24.80, pretty close to 25 in 30 days. Okay, so $67. Again, I don't think the put's going to decay that much. This is not what I was looking at earlier. I don't know what changed there. The volatility was lower when I opened this trade yesterday. I don't know why it spiked, but that's okay. We'll just take these numbers as they are, Fernando, because it's going to affect the whole trade. Now, what I had mentioned to you, sorry to backtrack, about the bear put debit spread, selling the 20, I'm sorry, not selling the 24, it would have been, sorry, the 24, I'm sorry, and buying the 26. It's in the money so that the stock can move up to 23 or 23.50, and I'm still looking at full profit on that bear put debit spread in that case. That would be an in the money bear put debit spread starting at 24 over here with the stock trading at 22.60. Fernando's maybe talking about selling an out of the money 22 put to potentially not be assigned and start off with an in the money put at 24, but I don't care because my broker would likely exercise this long to deliver the short on the bear put debit spread if that happens. I'm okay with it. But maybe Fernando's looking for an out of the money debit spread that's a lower cost, maybe selling the 22 and buying the 24. Fernando, I'm just going to keep a 2-point spread on this position. And we do it shorter term. I want my protection to be far out in time with the married put approach, following the 3 rules in the blueprint, the time value decay curve. It's going to decay more slowly than trying to buy month by month by month. And I'm going to have a higher annualized cost if I buy month by month by month, as opposed to buying 5 or 6 months out directly. But what would I do? I got to go to November. This one doesn't have weeklies. That's fine. Oh, it's only a 20 and a 22.50. So let's do the 22.50 25 and at the money, Fernando, because it's got better premium. This would only be 15 cents in this case. I'm going to do 22.50 in the 25 bear put debit spread. We're selling to open slightly out of the money, the at the money 22.50, Fernando, and buying the 25 in this case. And I just want to take these to normal numbers. There we go. All right. So we're paying what? 245. Sorry about that. 245 for the 25 put. And we're getting 92 cents back. So we're paying a debit of 153 on this position. Now, this gives us sort of that check mark profit and loss chart in this case. My cost basis increases up to 27.88. I add to the debit on the position. But as Fernando mentioned, it gives me a lower risk on the trade in this case. And even though I increase the debit on the position, we have a lower risk to the downside. Now, actually, the highest risk is right here. Okay, you lower the further risk to the downside because that extra profit from the bear put debit spread. And now your maximum risk is here at 25. Okay, and of course, still have the infinite upside profit if the stock banks up above here, 26.20, 26.30. That's when the infinite profit starts to come into play. So effectively, what has this done? Well, this is similar, Fernando. It's a parity trade to doing that income method number 6, isn't it? Just you wouldn't do it that way, but you could. Doing this at or out of the money bear put debit spread on this trade and the married put is the same as doing an income method number 6 position right away. The bear call credit spread in the blueprint. It has the same effect. You get that same heartbeat. But what did we do? Now the infinite upside profit potential before on just the married put kicked in somewhere around here. Now that's moved up. I need a higher movement now to see that kind of growth. We sort of gave ourselves a little profit here in this 22.50 strike range. But now if the stock moves up to these values, we're in the red. So why don't I do an income method number 6 right away? Does this reduce my risk to the downside? Yes. But it also reduced the potential profit or creates a loss in the initial target that I would have had for this stock, opening it as a long-term married put. Now, I'm not planning on exiting in 30 days, but my target would have been if the stock moved up to 23.75, right, on 11.3. Yeah. Oh, no, we were at 11.15. That's closer to the expiration. So let's just go 11.12. What would my position look like? I'm at a loss of $9. Whereas in the first trade, we were looking at a profit, 25 cents, 30 cents, or when I changed the volatility, it dropped to 16 cents. What was that 10% move? We were up at 24.80. Is that correct? I'm at a loss of $40, where we would have been a profit of about 70 cents or $70, excuse me, in that scenario for fair comparison. So, did you lower the risk to 2.5%? Did you lower it further down? Here's about, 37. Yes, you did, because of that structure and the profit on the bear put debit spread or the profit on the bear call credit spread. If you did it that way, income method number 6. Why don't we do it right away? Because my target for opening this position is right exactly in that area where we're going back into the red, where I would have been profitable on the married put to begin with without even doing an income method. In that case, and I could do the income method after Fernando. That's why we don't force those income methods right away. That's what's described in the blueprint. So I like the fact that you're able to lower the risk. I mean, if you're at a fast mover and you think it's going to gap up to 30, 32, 33, and you're wrong and it drops down to 18, this is a good approach. I'm not going to argue that. But again, normally what I typically see 60, 62, 65% of the time on the married puts I open, they do this 3 to 6% movement in the first 20 to 30 days. So I wait for that to happen. Then I make an adjustment based on what my new expectation is for the stock going forward and what I'm looking for as well. Okay. If I go deep out of the money with the spread, it's not going to really do too much, but we'll take a look at it. I mean, it's going to change the dynamic. It's not going to lower the risk as much in that case. And there's very little probability of it ever happening. So I'll go down to 20 and 17 and a half. We're going to sell the 17 and a half, buy the 20. I'm sorry. Buy the 20. Sell the 17 and a half, Fernando, deep out of the money. And again, where's my loss? Look at these areas, 23, 24. I'm not really getting the kick. And down here, the risk's at 3.9%, and I have this huge profit if I'm wrong. Essentially, what you're kind of doing here is trying to draft in a complication to create almost what looks like a put ratio backspread. Is kind of what it is. But it's just curved because of the calendar dynamic of having the March put further out in time. Okay. This is not, again, this is just not something that is an income method because we're paying a debit. It's very small, I know, in this case. And it changes the risk to something that, yeah, still gives me unlimited upside, but this double check mark position, I don't really like, in my opinion. Yeah. So this would have been a $7 debit with the potential to make $2.50, right? $7.50 debit, 7 cents, really cheap. And it takes the risk down to 3.9%, which is just at one peak, and it has a chance to win here. If you're finding yourself, honestly, Fernando, I'll say it this way. If you're finding yourself that you're getting into married puts that are consistently either swinging up 8, 10, 12% in the first 20 to 30 days or falling, we're at 2260. Let's say this is about 19, so that's about 3 points, or falling 12 to 15% in the first 20 to 30 days. This is a structure that works for you. Again, 65% of the time, the stocks do exactly what I want and move up that 3 to 5% in the first 30 days. So I want that to be in my profit zone with the married put structure. Do an adjustment after that. Okay. And you say done with low IV now could bring up the structure when IV increases. Yeah, but remember what's happening. You're changing IV on 3 positions. The further output, which works in your favor, the sold put, which won't work in your favor. That's going to cost more to buy back. And this extra long put, which is closer to at the money, which should increase as well. But these 2 increases in implied volatilities are going to cancel each other out. The benefit would be, of course, that the long put that you have further out in time would have the most benefit of an increase in implied volatility. These 2 shorts will cancel each other out because they're going to be increasing close to the same. All right. Why complicate it? Again, if you're finding the stocks that do those moves, Fernando's, I'd consider this. I'm definitely not. So this is one of the reasons why it's not an income method. Number one reason is we don't do the debit spreads as an income method because they increase the cost and can increase the risk even if it's bearish. But this is a parity trade to what? A parity trade to doing an in-the-money bear call credit spread, sort of. It's sort of. You have this extra put here that gets profit to the downside, but if I did a bear call credit spread by selling the in-the-money 17.5 call and buying the 20 call, we'd get a similar risk-reward profile in this situation. But we don't do that because it's not our obligation. We don't want to give up the chance of getting assigned. Doing it with the bear put doesn't let it be assigned, but again, you've increased the upper break even in the first 20 to 30 days in this chance. Yeah, it's not a lot. Did you lower the risk so it's only at 1 point? Yes, you did. But you also put yourself in just a small win or small loss if the stock hit the initial expectations you should have for the married put trade as you go forward. Okay. All right. So that's my thoughts on that one. And related to that is Stefania. Let me just jot this down here. And Stefania had said, regarding the radioactive list for married put search, is this available in the standard membership? Yes, it is. Okay, so what we don't show is how and when you do how and when you would do the 12 different income methods that come off of this list. All right, that you would apply in the technique. That's only available in the blueprint. Why we do it, when to do it, how not to do it to get yourself into trouble by setting up an incorrect married put position or an incorrect income method in that case. But yes, the first default search you'll find when you go to married put and you go to search is radioactive sorted by earnings per share growth. This is the exact criteria that we start with on our positions. And again, for Fusion subscribers, Ernie just opened this new position here, different put that was used a few days ago. And mine was on ESI, as I mentioned. I think I got the stock at 22.40. And again, we bought the March 25 strike put for a risk of 5.1%. It's different price. Is it gone now? Oh, there it is. Jeez, sorry, folks. So yeah, it's about 22.40 and bought the May, not the December put closer in for a risk of 5.1% on the position. 90% of those positions we post in the Fusion portfolio come from this list. Occasionally I'll do others. And many radioactive traders have seen the changes I might make to this default list to meet my criteria, my cost basis that I'm looking for my portfolio, that I can use, the max price I can use on the underlying securities, the risks that I look for, and maybe one or two additional criteria I might enter in those cases. Okay? All right. So yes, Stefania, it's available on all levels of standard service, that default radioactive screen. In that case, we talk about the cover call picks of the day, the monthly picks of the day, the weekly picks of the day. Those are not available on the end of day service. Oh, sorry. Yeah, those aren't available on the end of day service in that case, but the married put default screen at end of day is still there as well.